Most retirees think the danger arrives as a tax bill. That is not how it begins. It begins much earlier than that. It begins in the stories people tell themselves while they are still calm. My income will be lower in retirement. My taxes should go down. I can start taking Social Security when I want. I can convert later. The Medicare stuff is probably small. The IRS brackets are just numbers on a page. That is how people talk before the machinery actually touches them. Then the machinery touches them. A deduction phases out, a Medicare surcharge shows up 2 years late, and feels like an ambush. Social Security turns out not to be as tax-free as they imagined. A one-time spike in income refuses to stay in the past. The tax code gives with one hand and then starts taking back with the other the moment you cross the wrong line. And by the time most people realize what happened, they are not planning anymore. They are reacting. That is the sentence I want you to remember. In retirement, the biggest tax mistakes are rarely mistakes of arithmetic. They are mistakes of sequence. You took income in the wrong year, you crossed the wrong threshold, you missed the deduction while it was still available. You let one part of the system talk to another part of the system in a way that made your life needlessly expensive, and because the systems are all braided together, one mistake rarely stays alone. That is the real problem. People think retirement tax planning is about one line on a return. It is not. It is a choreography problem. The standard deduction talks to the senior bonus. The senior bonus talks to your adjusted gross income. Your income talks to Social Security taxation. Your modified adjusted gross income talks to Medicare premiums. A spike this year can cost you 2 years from now. A Roth conversion helps one part of the picture and hurts another. If you size it stupidly, a charitable move saves one person quietly and another person not at all, because the surrounding facts are different. This is why I have always disliked generic retirement advice. Generic advice makes people feel safe until reality gets specific. Reality is always specific. And this year, the tax picture for retirees is becoming more specific, not less. That is the first mechanism. I call it the retirement squeeze. Most people imagine retirement as a release. Salary stops. Work slows, time opens up. Surely the tax pressure eases. Surely the government becomes less interested in a household that is no longer climbing a career ladder. That is what people tell themselves. But what actually happens for many households is that earned income disappears and is replaced by a more complicated mix: Social Security, IRA withdrawals, pension income, investment income, required distributions later, medical costs, property taxes, and a tax code full of cliffs, phase-outs, and stealth triggers that were easy to ignore while life was simpler. That is not a release. That is a rearrangement. And if you do not understand the new arrangement, the government will understand it for you. Now let us begin with the thing most people notice first, because it sounds generous: the bigger standard deduction and the new senior bonus. This is the kind of headline people love because it feels like relief. A larger deduction, extra tax shielding for people over 65, a bigger amount carved away from taxable income before the tax rates take their bite. That all sounds wonderful, and in some cases it is, but this is where ordinary people make their first big mistake. They assume that because the shield is larger, the danger is smaller. That is not necessarily true. A larger shield does not remove the game. It changes the thresholds inside the game. That is a very different thing. If you are married filing jointly and both spouses are over 65, the total deduction stack can become large enough to make a couple feel temporarily invincible. They start saying things like this: maybe our Social Security will barely be taxed. Maybe we can take a little extra out this year. Maybe the income doesn't matter that much. Maybe we are under the radar. That is exactly when people begin walking toward the cliff with a smile on their face. Because deductions do not remove the need for discipline, they increase the value of discipline. That is the second mechanism, I call it, the false cushion. A cushion in retirement is only useful if you understand how quickly it can disappear once the wrong kind of income lands on top of it. The senior bonus in particular creates a dangerous psychological effect because it sounds like a fixed gift. It is not fixed. It is conditional. Once you start moving through the phase-out zone, the government begins taking part of that gift back. That is what people underestimate. They hear bonus deduction, and they mentally file it under certainty. In reality, it behaves more like a zone of privilege. You are invited in. You can benefit from it. But if your income crosses certain levels, the invitation gets revoked piece by piece. That matters enormously, because phase-outs do not just cost you the deduction itself. They distort your real marginal cost of additional income. People always think in simple rates: 12%, 22%, 24%. That is beginner math. Retirement math is uglier. because a dollar of extra income can do several things at once. It can be taxed directly, it can reduce the senior bonus, it can make more of your Social Security taxable, it can push you closer to or over a Medicare threshold. And suddenly a dollar that looked harmless on the surface becomes one of the most expensive dollars in your year. That is how stealth taxes work. They are not announced like a billboard, they are hidden inside interactions. This is why I say retirement is not about lower income, it is about cleaner income. There is a difference. A retired couple can have what looks like modest total inflow and still trigger expensive consequences if the inflow arrives in the wrong form and the wrong order. That is what most retirees do not understand until it hurts. Now let us talk about Social Security, because this is the area where people are consistently wrong in the most confident voice. They say, I already paid tax into Social Security. Why should my benefits be taxed now? That is not the right question. The right question is, what does the code currently count when it decides whether more of my benefit becomes taxable? Once you ask the right question, the whole picture changes. Social Security taxation is not merely about the benefit amount. It is about the rest of the income picture surrounding that benefit. And this is why the new deduction landscape matters. Not because the Social Security rules themselves have suddenly become merciful, but because the interaction between deductions and taxable income can create a temporary washout effect for some households. That sounds good. It is good. It is also temporary and conditional. That is the part I care about. A married couple may look at the larger deduction stack and realize that part or even much of their Social Security is effectively being neutralized on the return. Wonderful. But then they make the classic mistake. They assume that because the current year washes out nicely, the system has become friendlier in general. Number the washout is not the system becoming kind. It is the system creating a narrow corridor. And narrow corridors are not places to celebrate. They are places to move carefully. This is the third mechanism. I call it the temporary corridor. A temporary corridor exists whenever the tax code gives you a brief range where income can still be managed with grace before the walls close in. The senior bonus can create one, a low income year can create one. A gap between retirement and required distributions can create one. The death of one income source and the delayed start of another can create one. Most people waste these corridors because they see them as rest. I see them as maneuvering room. That is what wealthy retirees understand, and average retirees do not. A good year on paper is not permission to relax. It is a chance to reposition. Maybe that means a Roth conversion while your effective tax cost is still civilized. Maybe it means a qualified charitable distribution later instead of waiting until your balances force larger taxable distributions. Maybe it means realizing gains in a year where the surrounding income is unusually favorable. Maybe it means not taking the extra IRA withdrawal you emotionally wanted because the invisible cost of that withdrawal is much higher than the face value suggests. That is what retirement tax intelligence actually looks like, not celebrating the corridor, using it. Now we need to talk about SALT, because this is the kind of topic that sounds boring until it changes real household math. The increase in the state and local tax deduction cap is one of those developments that people in high-tax states notice immediately and everyone else shrugs at. That is understandable. But shrugging at it is a mistake if you are the kind of retiree whose property taxes, state taxes, and itemized deductions have been quietly trapped under a cap for years. A much larger SALT cap can feel like a genuine release. For some people it is, but again, we return to the same pattern. The relief is not clean. It is conditional. Once income climbs through the relevant phase-out range, the value begins to compress. That means the old habit of thinking about deductions as fixed goodies is once again dangerous. The government loves deductions that feel simple in conversation and become slippery in actual use. That is how complexity hides inside generosity. This matters especially for homeowners and retirees in high-cost, high-tax areas who may suddenly find themselves itemizing again or receiving much more value from doing so than they did in earlier years. That can make certain strategies more appealing. It can also make ordinary planning mistakes much more expensive because the return has more moving parts to coordinate, and when the return gets more interesting, the penalty for passivity rises. That is the fourth mechanism. I call it the expanded field. An expanded field is what happens when the code gives you more opportunities at the same time. It gives you more ways to misstep. SALT relief does that. A bigger senior deduction does that. The coexistence of taxable Social Security, itemized deduction possibilities, Medicare thresholds, and retirement account withdrawals does that. The field is larger. That sounds positive. It is positive, only if you know how to move inside it. Otherwise, a larger field just means more places to get lost. Now, I want to move to the part that ambushes people most often because it feels so unfair that they almost cannot believe it is real. Medicare or MA. I have watched perfectly intelligent retirees lose their composure over this because it violates their sense of time. They think, my income is lower now. Why are my premiums jumping now? Because the government is looking backward. That is the whole answer. Medicare uses a 2-year look back for these surcharges. So you may be living a much quieter life in 2026 and still be paying for an income spike that happened in 2024. That spike might have come from the sale of a property, a Roth conversion, a big capital gain, a severance package, a business exit, a once-in-a-lifetime distribution, or just an ugly tax year where too much landed at once. The reason almost does not matter. What matters is that the system remembers. This is where retirees get caught because they think in current cash flow, the government thinks in reported history. And when those two clocks are misaligned, pain appears. That is the fifth mechanism. I call it delayed punishment. Delayed punishment is one of the most dangerous forces in financial life because it severs cause from effect. By the time the higher premium arrives, the event that caused it may feel emotionally old. You have already filed that return. You have already moved on. In your mind, that year is closed. In the government's mind, that year is still talking. And if you do not know about Form SSA, 44 and other legitimate ways to notify Social Security about certain life-changing events. When income has fallen, you can end up quietly overpaying while assuming the system is simply immovable. It is not always immovable, but it does not move on its own out of kindness. That is the point. Retirees who save money in this area are not usually luckier. They are faster. They understand that the moment the premium notice arrives is not the moment to sigh and start paying. It is the moment to ask whether the underlying facts of life have changed enough to justify relief and whether the right paperwork has been filed quickly enough. This is why I say retirement tax planning is mostly a timing discipline. The rates matter, the deductions matter, the thresholds matter, but timing governs everything. Income timing, deduction timing, premium timing, appeal timing, conversion timing, distribution timing, spousal timing, widowhood timing, everything is timing. Which brings me to the cruelest part of all of this, widowhood. Most couples do not plan around this with enough seriousness because it feels emotionally distasteful. Fine, but feelings do not cancel the math. A married couple can sit in one filing status and enjoy one set of thresholds, one set of deduction dynamics, and one tax environment. Then one spouse dies, and the surviving spouse eventually faces a very different filing reality with much less favorable thresholds, while many of the income sources remain stubbornly large. That is the widow's tax problem, and it is not a fringe issue. It is one of the most underappreciated traps in retirement. If you are sitting on large pre-tax balances and you keep telling yourself that later is the easy time to deal with taxes, you may be setting up one spouse to inherit not just money, but a far more hostile tax environment wrapped around that money. That is why strategic Roth conversion during the right quarter years can matter far more than people realize. Not because everyone should convert everything. That is foolish because some couples should recognize that the tax bill they are avoiding together today may become a much uglier tax bill for one person later. That is the sixth mechanism. I call it surviving spouse compression. The same income compressed into a less generous filing structure becomes more painful. And if you do not see that pain early enough, you miss the years when you might have softened it at a tolerable cost. Now let us come to the action side because I do not want this to sound like one long warning without a map. If I were guiding a retiree or near retiree into 2026, I would begin with 4 questions. First, where does your income actually come from? Not in broad emotional categories. Exactly, Social Security, pension, IRA, Roth, brokerage, rental, business interest, dividends, capital gains, everything. Second, which parts of that income picture are controllable this year? You cannot manage what is fixed. You can only manage what still listens. Maybe the pension is fixed. Fine. Maybe Social Security has already started. Fine. But maybe IRA withdrawals are more flexible than you think. Maybe a Roth conversion is optional. Maybe charitable giving can be shifted from after. Tax generosity to a qualified charitable distribution later. Maybe capital gains can be deferred or harvested differently. Maybe you can choose not merely how much income to have, but what form of income will do the least damage. Third, where are the cliffs? I want the exact phase-out ranges, the exact Medicare thresholds, the exact points where the senior bonus starts disappearing, the exact points where deductions lose force, the exact points where $1 extra becomes far more expensive than it looks. Retirees who ignore the cliffs always think they are making small choices. They are often walking into waterfalls. Fourth, what is the 2-year echo? What you are doing today may not only shape today's taxes, it may shape premiums, taxation, and choices later. A good year is never just a good year. It is often the beginning of a chain. That is how I would think. Then I would build the plan from those answers, not from slogans, not from viral tips. Not from Roth conversions are always good, or just keep your income low, or Social Security is basically tax-free now. That is all lazy language. Lazy language creates expensive retirees. Now let me be very honest about something. Many people hearing this will want one clear rule. Should I stay under the senior bonus phase-out at all costs? Should I avoid conversions completely? Should I itemize no matter what? Should I hurry to file SSA 44? Should I stop Social Security number? That is not how intelligent planning works. There is no single commandment. There is only sequence and trade-off. Sometimes staying under the phase-out is worth it. Sometimes taking more income now is smarter because it prevents a larger future disaster. Sometimes a Roth conversion that pushes you slightly into a worse bracket is still correct because it prevents years of uglier taxation later. Sometimes the tax bill this year is not the real enemy. Sometimes the real enemy is the cumulative chain you are building by doing nothing. That is why the average retiree gets this wrong. He thinks in annual pain. The wise retiree thinks in lifetime structure. That is the seventh mechanism. I call it local pain versus total pain. The local pain is what you pay this year. The total pain is what the entire sequence cost you over time. Many bad retirement tax decisions are born from trying too hard to minimize the local pain while accidentally maximizing the total pain. That is the hidden trap. Now let me close this the way I think Buffett should close it. Retirement is not a reward from the tax code. It is a negotiation with the tax code. The market may reward patience. The government rewards sequence. If you bring wage earner thinking into retirement, you will assume lower work means lower taxes and a simpler life. Sometimes that happens. Often it does not, because retirement income is not simple income. It is layered income, and layered income interacts with layered rules. The standard deduction is not just a deduction. It is a shield that can shrink. The senior bonus is not just a gift. It is a corridor with walls. The SALT relief is not just tax relief. It is optionality with a phase-out attached. Medicare is not just health care. It is a delayed billing system tied to reported income. Social Security is not just a benefit. It is a tax interaction waiting to happen. A Roth conversion is not just a tax move. It is a time trade. A spouse. Death is not just an emotional event. It is a filing status event. Once you see all of that, retirement stops being a tax season problem and becomes what it really is, an operating system. And good operating systems are designed before the pressure starts, not after. So if you want the simplest practical advice I can give, here it is. Audit your income before the government does. Find your cliffs before you walk over them. Use good corridor years while you still have them. Do not let a 2-year-old spike keep taxing you if the law gives you a path to correct it. Do not assume bigger deductions mean you can stop caring. And above all, stop asking, what is my tax bracket? Start asking, what sequence is my money entering this system in, and what hidden costs wake up if I get the order wrong? That is the real question. And retirees who ask the real question keep more of what they spent their whole lives building. Retirees who ask the lazy question usually hand a painful amount of it back.